Hello everybody and welcome to P7 revision class number 2. In our first class we focused entirely, I think, we focused very heavily on the ethics and professional issues part of the course. So we focused, on ethics questions, practice management questions, etc. And we ended up looking at 3 of those, if my memory is correct. What we're going to do tonight in class number 2 is focus very heavily, good evening, focus very heavily on the big question number 1. The big question number 1, of course, is primarily an exercise in identifying different types of risk from a big scenario. But often the question will then go on further and have some audit testing in it as well, which is nice because it means if we focus on these nice big questions, we're getting some practice not only of risk, but also of the audit work part of the syllabus. And the audit work, the testing part of the syllabus, often has its own individual exam questions as well. So quite an intensive night of work ahead. In terms of illness, part of me's got a bit better, the coughing is still there, but hopefully not quite as bad as it has been, so hopefully we're on a bit of a mend. But anyway, not to worry, whatever happens, we will be fine. So then, a few other things have been uploaded within the last day or 3, so hopefully I think now everything that should be there is there. And you should have access to my exam tips, what I think might be coming up this time, and the audit standards summaries there, and the progress test questions are there, and everything's there, I think, probably. Anyway, let's get going then, and take a look at the risk stuff. Okay then. So, question number 1 on the exam, which is where the risk will typically be found. Is a 35 marker. And typically your examiner will divide it up like this. There will be 4 professional marks, usually all in question number 1, and often the other 31 marks, when we first look at it at least, appear to be one requirement. You read the requirements and it simply will say responds to the partner's email, which means reading the requirements doesn't really help us because we've got to go and find the partner's email to see what the partner wants. Now, in the old days, the requirements were actually laid out at the end of the story. It's been for about the last 2 to 3 years that your examiners started putting it into an email in the middle of the story. Doesn't really change anything. She will put a box around it typically, so you can go and find it nice and easily. Just read what the partner is asking and make sure you break down what the partner wants into its individual components, and then we can plan from there. Professional marks, I will talk about those when we look at the first question this evening. Always best with those to do it as we're doing it, I think, rather than talk about it separately. But before we look at any questions, we need to start thinking about risk and exam technique. Now, this is probably the most important thing on P7 in terms of exam technique for you to understand. Because the biggest individual part of any question is normally question 1, part A. It could be over 20 marks in its own right. So it's critical that you know what you're doing with risk. So one potential question you will get asked is, here is a story, describe the audit risks. And if you are asked to describe the audit risks, then you need to remember that audit risk is the risk that the financial statements are materially misstated and the auditor fails to detect this. Now that, of course, is simply F8 knowledge, technical knowledge being remembered. So hopefully nothing complicated in that. So if it's an audit risk question, there are two things to look out for in the story. Why might the accounts be wrong? The risk of material misstatement. Why might the auditor have a problem spotting that the accounts are wrong? Detection risk. Second type of question is sometimes she will ask for the risks of material misstatement. And in the old days, this used to be known as financial statement risk. And I tell you that because one of the questions we'll be looking at tonight is back in 2011, 3 years ago, when it was still being called financial statement risk. Well, if that comes up, it's the same as that. So this is the same as an audit risk question, except there won't be any detection risks to go in the answer. So in essence, those two things are the same thing. We don't normally get many detection risks on the P7 exam anyway. So frankly, if you think those are the same thing, audit risk, risk of material misstatement, it's not going to change your life very much, if at all. However, the third type of risk question is totally different. And that is a business risk question. Sometimes she will start a question with business risk and then ask about the risk of material misstatement. So sometimes she will combine these as two separate parts of a question. Now, if audit risk is mostly about the risk of material misstatement, I suggest the two things here you need to understand are what sort of things are the risk of material misstatement and what sort of things are business risks. If you can get your head around that, all is good. Well, the risk of material misstatement is, as its name suggests, the danger that the accounts are materially wrong. So whenever you are explaining one of these, you need to be talking about the accounts, the financial statements. So you need to say, which accounting standard do you think is relevant? And preferably, which specific rule do you think they're at risk of breaking? Why do you think they're at risk of breaking it? What's your logic for saying, oh, they might get that wrong? And thirdly, do you think they are likely to overstate, understate, or if it's not numbers but disclosure requirements, under-disclose the item? Example coming up very shortly with this, but that is how all risks of material misstatement need to be explained. Follow that sort of policy and it becomes a very mechanical process. The only way that you can really screw this up, let me change that, the only two ways that this can go wrong are, number one, you don't know enough about the accounting rules to know what the mistakes might be. Well, I can't do much about that. If you don't know your accounting rules, you need to know them by December the 1st. Or secondly, you spot the accounting issue, but you don't explain it in the way I've just put up on the screen. You do something else. So that's the risk of material misstatement. If the question says business risk, then all you've got to do with this one is describe the potential damage to the company. So stop thinking about debits and credits and just talk about the potential damage to the company. Now, I suppose we could again refer to Tesco's at this moment. Tesco's have managed to get their accounts wrong. Risk of material misstatement is the fact that their revenue is quite complicated because some of it is their suppliers paying them rebates and rewards for how much stuff gets sold. It's a bit complicated. That is a risk of material misstatement. What's the business risk to Tesco's of all of this? Well, the business risk, quite clearly, is the huge reputation damage that they've suffered because they've managed to get their accounts wrong by such a huge amount. There's also the damage to the board's reputation. There's also the damage to the company going forward because they will now have a new chief executive, new chief finance officer, and the chairman's going, so a new chairman, 3 new people all at the same time, and that leads to a lack of continuity in terms of strategy. So business risk is problems for the company. Risk of material misstatement is problems to their accounts specifically. Right, now that, to a great extent, is all you really need to know. From that point onwards, it becomes an exercise in simply practicing questions. But before we go any further into the actual practice of questions, there's one more thing I just want to reintroduce to you in terms of technique. Often, at the end of a risk question, it will ask you another type of question. Either matters and evidence, or maybe matters and procedures, which to a great extent are the same thing. Now, if it's a risk question, it will probably be matters plus procedures. Let me explain why. When you are planning an audit and assessing risk, you then have to decide on your response to that risk, and the response to that risk will be the audit tests that you're going to do, the procedures. So at the planning stage, you might describe, here are some matters I'm considering, and therefore here are the procedures we will do in the future on this audit. If the question is a matters and evidence question, it typically is set at the other end of the audit process when you are reviewing the work that's already been done, and you have to describe the evidence you would expect to find on the file. So a procedure might be inspect, invoice to agree, I don't know, amount paid. And notice, by the way, always say why. An evidence question, well, the evidence is the copy of the invoice. But I'd still say to agree the amount paid, because you must always explain everything. So you can see that whether it is evidence or procedures doesn't really change most of what you write, because let's face it, invoice to agree amount paid, invoice to agree amount paid, same thing. And that's the main body of your answer. So not a huge issue. If it says evidence and you write procedures, or it says procedures and you write evidence, you're going to end up writing pretty much the same thing anyway. So relax. So when we get this type of question, what should we be doing? Whoops, we shouldn't be doing that. We should be doing that. Well, the matters to consider will typically be, what are the relevant accounting rules for this situation? So yet again, as we seem to have to do so often on this course, highlight the relevant accounting standard and the relevant rules. But now we don't just mention the area that's at risk of being wrong. Typically with this type of question, we're in with a chance of being able to tell already if the client's getting it right or not. And if they're not getting it right, I would assess the materiality of their mistake. Then evidence procedures. Now for this, as maybe you remember from the teaching phase, I would typically be saying to you, think about AEIOU, the 5 basic types of audit test. So think analytical, inquiry, who can you ask, inspect, observe, recalc, you, late. I would also suggest thinking DADA 3. So this is the types of evidence you can test. So ask yourself, what documents would exist? Are there assets you could look at? Is it worth asking the directors for a management representation? Is there anything in the accounting system you could look at? Is it worth looking at the cash book, the asset register, purchase day book, stuff like that? And are there any third parties worth asking? And armed with those 2 lists of 5 ideas, I can normally come up with plenty. But when you get a matters and evidence or matters and procedures question, there is normally a little story. And I find that another way of getting the evidence or the procedures is simply to test every fact, every date, every event in the story. And what's nice about that method is you don't need to actually understand why you need to check that those facts are correct. If it says something happened on October the 14th, 2014, check it happened on October the, whatever I just said, check it happened on that date. You don't need to necessarily understand why it's important that you do know it happened and it did happen on that date. Just check it. Otherwise, I mean, if it wasn't important, why would she tell you? Okay, well, I've very quickly given you the exam technique for probably the 2 most important things on the course. But of course, with technique, none of that's much use unless we now practice it. So the next stage of the exercise is for us to look at some examples of past exam question number 1s and use this technique to work through and get ourselves to answers. So that's what we're going to do. We will break up those questions a bit because I've got 3 planned for tonight. I'm not sure if we'll squeeze them all in, if I'm being honest, but we'll see. 3 planned for tonight, and that's a lot of hard, intensive work because there's going to be accounting rules all over the place here. So many accounting standards will get mentioned. So I'll break it up a little bit with some of the technical knowledge on the P7 course, just to make sure we've covered a few bits of that. So here we go, and we are going to start with this one. Of course, we know that dates are important. This is the real June 11 exam paper that we're going to look at. So, for the purposes of this exam, we have to pretend that it is early June 2011, because the dates in the question are potentially going to be relevant to that date. So it is June 2011. Here is the storyline. But before we look at that, let's go down to the end of the question and look at part A. Now, nothing much has changed, but this was before we went to the 35 marks for question 1. But it's 37 marks in total, which is pretty much the same thing, pretty close. And one other thing to notice here, there's only 2 professional marks in this question, for the simple reason that the other 2 professional marks were in question number 2. But for your exam, all 4 professional marks will be in one question. It doesn't change anything about how you're going to try to earn them, but they'll all be in one question, probably question 1. Okay, the requirement. Ooh, looks a bit scary. 27 marks. It's a beast. And it says respond to the partner's email. Well, we can't plan this one then unless we know what the partner wants. So let's go find out. Email. Ah, there we go. There's an email, look. And you can see that the email splits that 27 marks into 2. 16 and 11 are still fairly big amounts of marks, so still a bit scary. But before we read the partner's email, because the email is not the first thing we're told, there's a bit of story above it, I think it probably makes sense if we read the opening bit of the story, then go read the partner's email, and then start planning our answer. Okay, so that's what we're going to do. Right, here we go then. You are a senior audit manager in Suki, firm of accountants. This morning you've been reassigned to the audit bill, long-standing audit client. Ooh, long-standing client, so if there's any ethics in here, maybe we're meant to mention that. As the manager previously assigned to the client has been taken ill. Bill has a year ending 30th of June. So, this exam came up June 11. So the year end has not happened yet. Now that is fairly typical. We would normally be planning audits before the year end, so nothing odd there. But just to get your feel for what's going on in this question, we are 3 weeks before the year end. The audit planning has been largely completed by the previously assigned audit manager, Tara Lafayette, who had been recruited by your firm 4 months ago. So, someone has started planning the audit. We are going to take this over. Okay, no problem. Bill is a property development company specialising in the regeneration and refurbishment of old industrial buildings, which are sold for commercial or residential use. All property developments performed under specifically negotiated fixed price contracts. Well, I'm already thinking fixed price contracts is going to be IAS 11. Construction contracts is beginning to look very relevant here. Just a word on that. Some of you will go, whoa, Mr. Tutor person, there is a new accounting standard on revenue, and that is replacing large amounts of IAS 11, IAS 18. Yes, I know it is, but it's not on the syllabus yet, so forget it. Right, so all property developments performed under specifically negotiated fixed price contracts. Company founded 35 years ago, two brothers who own the majority of the company's share capital. Alex and Ben are nearing retirement age and are planning to sell the company within the next 2 years. Right, so the people running the company also own it and are looking to sell it soon. So I read that and I'm starting to think, ooh, if you want to sell a company, you want to make things look as good as possible, don't you? Now, I'm not going to jump to any conclusions yet, because until I read the partner's email, I don't actually know what the question's going to ask me. It then says, the forecast revenue for the year is 10.8 million. The profit before tax is forecast to be 2.5, and total assets are forecast to be 95 million. And when I see revenue, profit and assets figures being given to me, I, rather like you I suspect, am thinking, whoops, that is there to help me assess the materiality of stuff. That's what I am thinking. Okay, so what do we know so far? Company's year end is June. They're a property development company. They have fixed price contracts with their customers. The owners also run the place and they're looking to sell it fairly soon. And I've been given some numbers to help me assess materiality. Right, let's see what we have to do. Part 1. Excuse me, still throat problems. I have just received some information on 2 significant issues that have arisen over the last week from Sam Compton, the company's finance director. This information is in attachment 1. I am asking you, right, here's the requirement, to prepare briefing notes for my use in which you explain the matters that should be considered in relation to the treatment of these 2 issues in the financial statements and the financial statement risks, so risks of material misstatement relating to them. I also want you to plan the recommended audit procedures to address those risks. So let's come down here and get a little answer plan set up. So A part 1, 16 marks. And what do we know so far? We know there's issue 1 and there's issue 2, but we don't know what the issues are yet. And for each of them, we've got to identify the relevant accounting issues, which sounds like accounting standards to me. So what are the rules? Why they might get it wrong. And some audit tests to deal with this. Okay, so that's what we've got to try to do. Just make sure we've got it all covered, which I think we have. That is worth 16 marks. It said in the main requirement at the end, the split is shown within the partner's email, which it is. It doesn't tell us how the marks split between the 2 issues, or between the three separate things we have to do for each of those two issues. So I think we have to assume that that's worth 8 and that's worth 8, which means when you think about it, there's only about 2 to 3 marks for each of these things. And it's worth us noting that because especially for the audit tests, we need to know how many tests we're meant to come up with. Right. So all we now need to do is to go read what the two issues are and start filling in the gaps. We've got a fairly standard risk of material misstatement question here. So we are now considering accounting issues and then audit tests. In terms of the audit tests, I'm thinking AEIOU, I'm thinking DAR 3. But also, if I'm about to read a story, there will be facts, events, numbers. So test the story, test the stuff that's in there. And that approach will also be what I do down there for those audit tests. When I'm talking about the risks of material misstatement, running out of colours here. Excuse me. I should try to say whether it's over or understated, etc. And also the risks of material misstatement. We've seen the numbers at the top of the question. We also, I'm assuming, are meant to talk about how material it all is. So it looks like quite a lot to do, but that's good because it breaks the requirement down into little bite-sized chunks. Now, I'm sorry about this, guys, but I'm going to have to go and just clear my throat because I'm really struggling. I'll be as quick as I can, 2 minutes hopefully, and then we'll come back. Maybe worth you going and having a look. Let's just go up here to give you something to do while I'm away. At attachment number 1, that's where I'll be picking it up. I'll be back as quickly as I can. About 2 minutes, okay? Sorry. Okay. Okay, apologies about that, guys. Should have brought some water with me at the beginning, but totally forgot. So, just to get us back into the swing of this, we are looking for what are the relevant accounting rules? Why might they get them wrong? How material might all of this be? And the audit tests that we will do in response. Here we go then. Information from Sam Compton. In the last week, 2 significant issues have arisen. We know. The first concerns a major contract involving the development of an old riverside warehouse into a conference centre in Bridgetown. Well, that, as I suggested earlier, is sounding like it is going to be IAS 11. An architect working on the development has discovered that the property will need significant additional structural improvements. Okay, let's stop reading for a moment. The main issue, and I'm not convinced I'm going to have enough room here, but let's give it a go, is IAS 11 says that when you've got a contract, you can recognise, let's not do it there, let's have a bit more room. Let's find some space. So, issue number 1. Remember, 8 marks we're looking for. So, what have we got? We've got IAS 11 that says that at the year end you can recognise or should recognise the percentage of profit in a contract based on how finished it is. However, if it is a loss-making contract, then the company should recognise 100% of the loss. So that is the basic accounting rule behind it. Let's now go and read the story and see if it is that, or maybe it's something more detailed, maybe I've totally missed the point, I don't know. Okay, so June 11, where's the question? I've lost it now, look, all the way back up here. So, where are we? An architect has discovered property will need significant improvements. The extra cost is $350. The contract was originally forecast to make a profit of $200. Well, if that's the case, and it's now expected to cost another $350, a profit of $200 is now a loss of $150. The development is currently about 1/3 complete. Now remember, the year end hasn't happened yet, but is close. So probably this will be about 1/3 finished at the year end. It's got a further 15 months to go, including the additional construction work, so that's not been done yet. The customer has been told that the completion of the contract will be delayed by about 2 months. However, the contract price is fixed, so the additional costs must be covered by bill. Whoops, don't need to do that, do we? Because we're on a separate page. So, coming down here, I've identified a relevant accounting rule. Is there a risk they get it wrong? Yes, because the risk is that they don't account for the $150,000 loss on the contract. So the original profit would have been 200k. There's now an extra cost of 350. So justify your numbers. Okay, the thing is, being only 1/3 complete, the original contract was a 200,000 profit. They might have decided not to account for any of the profit on the grounds it was only 1/3 complete, or they might have decided 200,000 profit times 1/3, which is 66,667, isn't it? I don't know, because they're not at the year end yet, so they might not have decided what to do at all. The danger at the year end is that 150 loss does not get recognised. Now, I do also want to consider how material this misstatement is, because it's risk of material misstatement. And if you divide 150,000 of loss by their profit figure for the year, what was their profit figure? It's up here, isn't it? Profit before tax, 2.5 million. Sorry, that's a bit untidy. So 150,000 over 2.5 million is that 6%, I think? And 6% would be just about considered material. Now, in fact, the mistake might be more than 6%, because I'm assuming that they're recognising 0 for this contract when it should be minus 150, hence a 150 mistake. There is a chance that in their forecast profit, they might be including 1/3 of the expected profit, 67,000. So in fact, the mistake might be more than 200 grand. But let's just keep it simple for now. Okay, so I've highlighted the relevant accounting rules and how material this could be. I've looked at the risk. Now what we need are some audit tests. Now, as I said, at this point you can take various approaches. I might go AEIOU, I might think DADA 3, but what I'm going to start by doing is going into the story, and whenever it says anything that is a fact, I'm going to test it. So, it says, there is a major contract, development of la la la. Well, if there's a contract, I suppose I ought to look at it to prove that there is a contract with a fixed price, because otherwise IAS 11 wouldn't apply. So I would like to inspect. Notice this is procedures, not evidence. We're planning the audit, the work's not been done yet, so you have to tell people what to do. Procedures. So inspect the contract to verify fixed price. And you'll need to do that to help calculate, of course, the projected loss that we have just said is going to happen. It also tells you that an architect has just said that they found additional work that needs doing, which is going to cost 350 grand. So how do you know that an architect has just found that? I'd ask the architect. So get confirmation, sorry, that's... So ask or inquire for written confirmation from the architect of the 350k of costs. Because of course they have not been spent yet. And then, ding, a light bulb goes on above my head as I remember to think about dates. This is a planning question. It is currently 3-4 weeks before the year end. These tests that you are planning to do, when will you actually do them? You will do them after the year end. And by the time you come back to do the audit tests, those costs might have been spent. So I would also review the post-year end cash book to verify amount of costs if already paid. Because by the time you come back, they might have been. Right, quick look. I think we've probably got at least 1, maybe 2 marks for talking about IAS 11. Get another mark for talking about the risk of not accounting for the loss, and another mark for materiality. So I reckon I've got 3 or 4 marks before the audit tests. I've got 3 audit tests, so I'm on 6 or 7 out of 8. So I can relax a bit, because I should have passed this by now, once I turn this into sentences. But I would like a couple of extra points, if I can, just to buff this out a bit. So let's go back to the question. It says the development is currently about one-third complete, and will take a further 15 months to finish. Well, we ought to check that is true. So I would also therefore like to inspect a copy of the budget for the contract to verify costs and 15 months left to complete. How do I know it's 1/3 finished? Well, at the year end, the company should be getting a surveyor to sign off how finished it is. So I would inspect a copy of the year end surveyor's completeness or completion statement to verify 1/3 complete. As always, yeah, 2, 2. I'm always trying to say why. Always trying to explain what I do. Now maybe, I think we've got enough at that point. If you're not sure you've got enough, having gone through the story and tested every fact that's in there, now think A-E-I-O-U, is there anything else I could do? A is analytical, comparing. I think each contract's probably fairly standalone, so I'm not sure what I'd compare it with, so I don't think that's going to work. E, inquiry. I can ask 2 types of people, directors and third parties. I've asked surveyors, they're sort of third-party experts. Experts. If we're going to rely on what that architect says, we ought to make sure that we've checked the qualifications, experience, and independence of that architect to verify his or her estimate is reliable. Worth getting a management representation? Can't think what I'd get them to confirm, to be honest. Inspecting anything? We've inspected documents. I suppose you could inspect correspondence with the customer, verifying all this extra work, extra 2 months, so you could do that. Sorry guys. Observe, recalculate. Again, I suppose you could recalculate the original 200,000 profit to make sure that figure was right. The fact is, I'm pretty sure I've got my 8 marks worth, but you can see that if you just think through AEIOU, DADA3, it can help to get an additional 2 or 3 points, which might be the difference between getting 6 out of 8 and 8 out of 8. But I'm pretty comfortable that I've got that first one sorted. So the first one is testing, do you understand the rules of IAS 11? But notice, even if you didn't understand IAS 11, you can still get all of the evidence marks. And that's about half of the 8 marks, just by testing every fact that's there, even if you've got no idea about the debits and credits that are going on. So let's now take the same approach for issue number 2. Again, 8 marks for highlighting relevant accounting rules. What do we think they might get wrong? How material is all of this? And some audit tests. So back to the question we will go. Second issue concerns one of Bill's specialist divisions. Ooh, divisions. I'm now thinking 2 accounting standards. I'm thinking segmental reporting, operating segments, IFRS 8 might prove to be relevant. And I'm also thinking divisions crop up in IFRS 5, discontinued operations. And I see I am not the only person thinking that. Trades under the name Treasured Homes, and which deals exclusively in the redevelopment of non-industrial historic buildings such as castles and forts, ruins, developed luxury residences. That sounds like a specific area of their business. I'm starting to think IFRS 5 is looking the most likely here. The management of Bill decided last week, that is a date, so let's look at the significance of it. It's early June, last week is before the year end, to sell this division. Right, they're not closing it, they are selling it. As although it is profitable, it generates a lower margin than the rest. Treasured Homes operates separately. Well, that's a point for IFRS 5 from the rest of the business, and generates approximately 15% of the total revenue, and that means it's material. In a board minute dated the 1st of June, so a few days ago, it was noticed interest has already been expressed in the division from a potential buyer. It's hoped the sale negotiations will soon commence, leading to a sale in August 2011. There is a specific office building and some other tangible assets sold as part of the deal. Right, these assets are recorded at 7.6 million. No redundancies necessary. Employees' contracts will transfer to the new owners. Okay, quite a lot of information in there. So let's start getting ourselves an answer plan. So, in terms of the IAS, IFRS, whatever, I think the issue here is fairly clearly IFRS 5, which is discontinued operations and assets held for sale. Well, which one shall we consider first? It's an asset held for sale under IFRS 5 if it's available for sale, they are actively trying to sell, and they expect a sale less than 1 year after the year end. If that is true, I don't care what the asset is, if it's held for sale, the assets should be separately disclosed on the statement of financial position. But of course, IFRS 5 also looks at discontinued operations. And if you have got a clearly separate part of the business which is material and which is closed or sold before the year end, or is held for sale at the year end, then it's a discontinued operation with separately disclosed performance in the statement of profit or loss, and also the cash flow statement, by the way. So here we've got two separate issues, and it takes a bit of a while to explain all of that, and that's not the only stuff, because you've got the assets mentioned at the end as well. So does it look like the assets of that division would be classed as held for sale? The answer is yes, they should. So what is the risk? The risk is under disclosure, because the assets are held for sale, and also it's looking like a discontinued operation, isn't it? Because it's clearly separate, clearly material, and on that basis it is a discontinued operation because it's held for sale at the year end. So in my answer I'd have to explain there's a risk the assets are not separately disclosed. There is also a risk that the performance of the division is not separately disclosed. Is it material? Well, yes. It's 15% of the business. And then we need some audit tests. Now again, AEIOU, DADA3, but before we do that, I think the easier thing to do is to go back into the story and test every detail you are told. And it tells you that the management decided last week to sell that division. How do you know that management decided to sell it? You would surely inspect the board minutes to confirm decision has been taken to sell. It says last year it generated 15% of revenue, operates separately, etc. We ought to test all of that, I suppose. So I would inspect prior year management accounts to recalculate its 15% of total revenue. It says interest has been expressed from a potential buyer. How do you know someone is interested? Well, presumably there has been some communication. So I would inspect communication. With the interested buyer. Okay. Because that will prove the interest, yep. Now it also says they expect a sale in August. And then again that little light bulb goes on, ding. When will you be doing your final audit? After the year end. If the year end is the end of June, when will you be doing that audit? Maybe July, more likely August, September, which means the sale may have happened. So if sold before final audit, I would want to inspect the sale agreement to verify the sale has happened, the proceeds, etc. And it may well be that I've already got 8 marks because I've got 4 decent audit tests. I've highlighted the main accounting issue, IFRS 5. I've highlighted the risks under disclosure. I've talked about materiality. I'm feeling pretty good about this, even though there is still another bit of the story there. Because it said there is a specific office building and some other tangible assets that will be sold as part of the deal. These assets are recorded at 7.6 million. If they expect to make a loss on those assets when they sell this assets held for sale, they need to write the assets down at the year end to recognise the loss they're expecting to make. So in my answer, I've amazingly got another accounting issue. You could say it's IAS 16. Assets must be held at no more than recoverable value. If held for sale, that's going to be proceeds. Risk, if sold at less than 7.6 million, they would be overstated at the year end. Audit tests. How do you know how much those assets are worth? Well, I might ask a qualified surveyor to value the assets at the year end. So third-party evidence. Or if they have been sold before final audit, inspect sales agreement to see if sold above 7.6 million. And that is how I would go about the first part of this question, the first 16 marks out of the 27. Notice in both of the issues I take a very mechanical approach. What are the accounting standards? What are the relevant rules? Does it look like they've got it right or not? What are the risks, in other words? How material is this? And then I think audit test by testing every piece of information that I'm given. Not difficult in terms of the technique. As long as you remember the technique, as long as you make sure you talk about overstatement, understatement, under disclosure, and as long as you make sure that you know your accounting. Because that question becomes very difficult if you don't understand IAS 11 or IFRS 5. Okay then, okay. Well, that's the first bit of the question. But there is more. Because in part 2, for the other 11 marks out of 27, it says, in addition, please critically evaluate the planning that has been completed by the previously assigned audit manager. Relevant details, attachment 2. Make sure you include discussion of any ethical matters and recommend any actions you think are necessary. So we are testing the quality of the planning that's already been done. So this is a quality control question. I need to look for ethical matters and actions, and that is all worth 11. So quality control, ethics, actions. The moment I see the word ethics, I say, ooh, I know all about that. Because ethics, we've been working on a list of 4 things, haven't we? We've been thinking threats to objectivity, we've been thinking confidentiality, we've been thinking integrity of client, and we've been thinking conflicts of interest. Quality control, well, that's about how work is carried out. Could be all manner of things, I don't really know. Probably the best thing I can do is go read that attachment and see if I can spot things that seem to be wrong. However, a few ideas just to get the brain's juices flowing. Quality control says things like follow the audit standards, I suppose. ISAs. It's things like document everything, pick the right staff, direct and supervise their work, etc., etc. So stuff like that. 11 marks, so quite a lot to do here. So let's go straight back to the question and go find attachment 2. There it is. Planning for the forthcoming audit is almost complete. Time has been saved by not carrying out procedures considered unnecessary for this long-standing audit client. I don't like the sound of that. Because if you're not doing something because a client is long-standing, aren't you effectively saying, ethics, there's a familiarity threat? Because cutting corners on your audit work shows a lack of professional skepticism. You're not challenging the client's stuff enough, presumably because you think you know the client well enough, you don't need to check. I think that's evidence of a familiarity threat. Now, either I'll put it in as an ethical point or I'll put it in as quality control, because cutting corners to save time will surely affect the quality of the work done. Surely. Forecast accounts obtained, placed on file, discussions held with management, analytical procedures performed on the statement of comprehensive income, now the profit or loss, but not on the statement of financial position, as there did not appear to be any significant movements. Well, that doesn't mean the numbers are right just because they haven't changed. Maybe they should have changed. So I've got another issue. Quality control issue here. Not enough analytical review or analytical procedures have been done. They are a requirement of ISA 315, so by not doing it, they are in breach of audit standards. You have to analytically review all of the primary statements in the accounts, not just one of them. Management confirmed there have been no changes to accounting systems and controls. For this reason, we do not. Do you notice a bit of a theme here? If you're criticising this planning and it keeps saying we haven't done this, not needed, not needed, if you're told they're not doing something, surely that's what you're meant to be criticising. If we're not checking the systems and controls, we're just relying on what management are telling us. As I said, lack of scepticism, no one's checking anything. You must check if controls have changed. You cannot simply rely on management. Not good enough. Management also confirmed, they're confirming a lot, aren't they, management, that there have been no changes to business operations other than the potential sale of treasured homes. All divisions operating normally, generating sufficient profit and cash. For this reason, the business risk of Bill is assessed as low, and no, common word in this story, isn't it? No further comments or discussions about business operations have been placed on file. Well, I'm sorry, but that represents an insufficient assessment of business risk, and I might also say that there is too much reliance on management representations, which is the worst quality evidence you can get. The matter that will demand the most audit work is the valuation of properties currently under development. Yeah, that's probably true. Especially the determination of the percentage completion. Absolutely, that is a subjective area. It's an estimate. It relies on experts. Completely agree. Historically, we have engaged a property valuation expert to provide a report on this area. Yeah, we suggested that as a test in the earlier part of the question. However, Bill has recently employed a newly qualified architect who will be happy to provide us with evidence concerning the stage of completion. Using this person to produce a report on all properties will save time and costs. Well, as I said earlier, if you're going to rely on experts, one of the things you need to assess is their qualifications, experience, independence. Well, this person is qualified, but they've only just qualified, which means they won't have so much experience. They also have only recently been employed with the company, which means they don't have much experience of this company's activities. Are they independent? Well, when you start a new job, don't you want to really impress your new boss and not upset them? So I'm not sure they are very independent. So, relying on the new architect, surveyor, I can't remember what it says, equals poor quality because of their lack of experience and independence. I mean, think about it. These guys who own this company are probably selling it within the next 2 years. There's the Treasured Homes division, which they're about to sell even sooner. The owners have got a clear incentive to overstate values. A brand new architect, surveyor, whatever it was, who's recently qualified, would be easy to manipulate. Really easy, because they'll be very keen to do the right thing for their new bosses. Thing we've not really had yet is ethics and actions. But that's the last paragraph, I think. Bill has recently completed the development of a luxury new office building in Newtown. Several of the office units are empty, and the management of Bill has offered the office space to our firm for a nominal rent of $100 per year. It's luxury, it's new, and trust me, there is no such thing as office space that costs $100 a year. The value of this would be huge, surely. So ethical issue sounds to me like a self-interest or maybe intimidation threat regarding the offer of the office, and it's going to be worth a lot of money. So what actions do we think we should take? Well, none yet, because we've not considered ethics. Down at the side of the page, and this is why you write it right at the start, otherwise you forget, I said ethics is about 4 things. So, Before we get down to actions, let's just run through them and see if we've missed anything. Safim. Self-interest, we've got in the answer. Self-review, I can't see any self-review here. Advocacy, no. Familiarity, in the answer. Intimidation, in the answer. Management, we're not being asked to do anything that's management. Are there any confidentiality issues? Are there things we should be reporting to an external person? Can't think of any. Integrity of client. Yes. The very fact that they are offering what could easily be construed to be a bribe. Conflict of not conflict of interest. The other way round, Paul. Integrity of client in offering the office. Actions. Well, in terms of the offer of the office, surely there's only one answer, isn't there? We have got to politely decline the cheap office because the value is simply too high. If you're concerned that we are too familiar with this client and there are integrity issues with the client, familiarity plus questions over integrity of client, I think we maybe ought to consider resigning. Now, this part of the question was worth 11 marks in total. I think I've got about 3 ethics issues, couple of actions, and I have got 6 quality control points, and 6 plus 5 is 11. Whew, well, that was fairly hard work. 27 marks worth of stuff, but it's not a 27-mark question. Instead, it's 2 8-mark questions in part 1, but even those broke into 3 separate points, maybe even 4. And the 11-mark question breaks into 3 bits. So really, this is loads and loads of little 2, 3, 4-mark questions. So don't be put off by big numbers. Go and break the requirements down. Where there are technique issues, for example with ethics, note down the technique. Only then do you go read the story. And as you saw there, if you've noted the technique down, even after you've filled your head with the story and now your head's starting to get confused, the technique is on the page screaming at you, read me. So read it and follow it. So nice question, part A of this, in helping us construct a sensible approach and just break the questions down. But we've not quite finished, because part A asked for briefing notes, and it is this for which there will be 4 professional marks. I think I've mentioned this before, but your examiner has been examiner since December 07, so 7 years, loads of exam papers, loads of questions, and briefing notes have been a requirement on every sitting, every single one. What do we need briefing notes to look like to get our 4 marks? Well, the first thing is the format, and the format requires who are they for, which of course is partner, who have they been written by, manager. It would actually be a good idea to put the date in here, so that if the manager reads this at some point in the future, he knows what information existed at the time you wrote this, and you sit your exam on December the 1st, so let's go with that, and a brief subject, which I suppose, what is the subject? It is accounting issues, quality control, ethics in relation to the audit of a company whose name I've forgotten already, of Bill. So I'd be tempted to say Bill Co. planning issues and keep it at that. Because these are notes for use by someone, they need a bit of format, which means an introduction. One sentence will be enough, and simply say what you're going to do. You know, as requested, here is my analysis of the two accounting issues, as well as the quality of the planning so far, some ethical issues and some actions I propose we might take. So basically just rewrite the partner's words. Then you will have the main content, which of course comes from A part 1 and part 2. There are a lot of things required, as we've just seen in this, so it needs some structure, which means headings. So each of your accounting issues should have headings. Accounting issue 1, Blair. Accounting rules, IASs. Risks of misstatement. Materiality assessment, audit tests. And then have all those headings again. This answer should be full of headings. And then at the end of your answer, a one-line conclusion. And you know what? The conclusion typically says the same thing all the time. Because in a 35-mark question, there are bound to be a lot of issues, aren't there? My conclusion is fairly easy to write, even before I've read the story. Lots of issues. We'll need to carefully plan our work, staffing, etc. of the audit. There we have it. 27 marks, 4 briefing notes, 4 marks for professional as well, all dealt with. Okay, well that leaves us almost having done our first big question. And sorry, there's only 2 professional marks in this, but when you sit, all the professional marks will be in one question, as I said. That then leaves us with one final part to do, part B. Much smaller, 4 marks each. And part 1 says, explain the inherent limitations, so the sort of things holding you back, which means auditors may not identify related parties and related party transactions. And part 2, recommend the audit procedures. Well, there's some technique for that, isn't there? AEIOU, DADA3, and test the story. So a little bit of sort of theory. Why is auditing related parties difficult? And I can plan my answer to that one right in front of you here. Why is it difficult to identify related parties and related party transactions? Well, maybe we should break it up using the and. Why is it difficult to identify related parties? Well, the rules are not simple. Who are related parties? We're related if I can control you, or you can control me, or both of us can be controlled by somebody else. And that is subjective. In fact, I'd say that's another issue. The subject of control is subjective. And another issue with identifying related parties is the client might not understand. And if you ask who are your related parties and they don't know what a related party is, they might not tell you. And also the client might want to hide relationships. So 4 marks is not looking difficult, because I reckon I've got 4 already, and I've not even separately considered related party transactions. Why are the transactions hard to identify? Well, often they might involve no cash. I mean, think about it. If we are brothers and you need something and my company makes it, I might let you have it for free. And if I let you have it for free, where's the proof that that transaction ever happened? Oddly, if I charge you $1 for something that's worth $1 million, it's far more likely to be spotted by the auditors because now there's a transaction, some cash is moving, it gets recorded. If I let you have something for free, much harder to spot. So those are the sort of things that part one is about, and the difficulties with related parties does come up on the exam a fair amount, so it's worth making sure you understand those difficulties. Audit procedures in relation to bills, transactions with Lantern. I would again go with this approach first. Let's go have a look at it. Test every fact, event, etc. So the two owners of this company have a sister who has an interior design company. During a review of board minutes performed as part of the planning, it was discovered that Bill has paid $225 to Lantern during the year. So, how do we know that that's been paid to Lantern during the year? Surely you're going to inspect the cash book and the bank statements. That's how we tell how much money's been paid to someone. Partly to confirm what has been paid, but also to see it is 225 and there's no other items in there as well. So that's to agree the amount. In respect of refurbishment of development properties. On further inquiry, it was also found that Lantern leases an office space from Bill under an informal arrangement between the two companies. Well, if they're leasing office space, how do we know that? Well, if it's an informal arrangement, there might not be any paperwork agreeing any of this. That's what informal means. There's no forms. So how do you know she is in that office? Inspect the office. To verify that she's in it. But also to assess how big it is, because that is going to help tell you its value. And with related party transactions, the values of them need to be disclosed, even if no money is being paid. I might therefore now have to get an expert to tell me the real market rate for such an office, so I can help assess how much of a commercial benefit she is getting. Now, I don't really know what's going on here. It's informal. I don't know how much money is being paid, or even if any money is being paid. So I suppose, as has correctly been suggested in the chat there, that the best starting point is to ask the management, and maybe also ask their sister, what's the terms of the arrangement? So, get confirmation from management and the sister of the terms and the length of the lease. And that is 4 tests, so I'm already fairly happy. I think I've got enough. So just testing the story usually gets you enough tests out of there. If you wanted to go down AEIOU, analytical is compare. Compare that office space with other office space currently being advertised to see how much it's being advertised for. That would be another way of finding out what the market rate is. We've done inquiry. Inspection. We've already inspected the premises. Suppose you could say inspect the board minutes where this would have been agreed to see if they've agreed a particular length of lease, particular amount to be paid. Nothing really to observe, anything to recalculate, probably not. But it's only worth 4 marks, and I've got 4 tests. And there we go, 37 marks of fun. Done. Took a while, but we got there. Now I know I took a couple of minutes earlier to get some water, but we've been going a long time. We need a break on these revision courses. It is currently 7:35. So I propose that we have a little 10-minute break at that point, and we aim to restart at 19:45. 10-minute break. I will see you in a little while. Okay, well, I had hoped to restart at 7:45, but I'm afraid I need another few minutes just to give my voice a little bit of a rest. Okay, so we've just done a question looking at accounting issues, risk of material misstatement in planning, including some audit procedures. We've also managed to get some more ethics done, some quality controls, a bit of practice management. So the question ones are very, very worth practicing because they get you coverage of multiple parts of the syllabus. And now we're going to do another question one. Yay! But just before we do another question one, I promised earlier I would break up the big questions a bit with some technical revision. And for the technical revision, we do need to make sure that we know our audit standards in particular. It's not just them, but there's always the strong likelihood that at least 3 or 4 audit standards will appear somewhere on the exam in one way or another. So let's have a little audit standard at this point. And one of the ones I think has a reasonable chance of coming up this time is 560, which is the audit standard on subsequent events. And as you might remember from the tuition phase, my preferred way of explaining this one is with a diagram. So there's the client's year end. Whoops, it's a bit of a mess, isn't it? I don't like that. Sorry, no, let's tidy it up. Ooh. And at some point after the year end, in come the auditors to do their audit work. And when you've finished it, you sign your audit report. And then at some point in the future, there's an annual general meeting where the shareholders agree the accounts, they're submitted to the authorities, and that's the final end of the article. Auditors, up until the point of the audit report, have an active audit duty, meaning you are auditing all the way up until then. And one of the reasons why you have to keep auditing until after the directors have signed the accounts is because that one accounting standard, IAS 10, events after the reporting period, is still applicable all the way up until the directors sign the accounts. Most accounting, of course, is about the things that happen during the year. IAS 10 says, but some things that happen after the end of the year are relevant too, either because they give more evidence of the company's true position at the year end, and in that case they are called adjusting events, or if something happens after the year end which has got nothing to do with the position at the year end, but is so significant that the shareholders should know about it, it gets disclosed. So as an auditor, you have got to be actively auditing that time period in order to be checking the events happening after the year end, the EARPs, in order to assess whether they need to be adjusting or disclosed. Now that's the relatively straightforward bit, as hopefully you remember. The more complicated bit of this audit standard is what happens if we get a problem. What if an error is found after the director signed the accounts and the audit report has been done? Now, potentially, there are two possible ways out of this. And it all depends on what the directors are going to do. The relatively easy one is if the directors refuse to change the financial statements or let you, the auditor, rewrite the audit report. Because if they refuse to let that happen, the accounts are wrong, but your audit report says they are right. But you've got no way of changing the audit report. So, not complicated, you've got to tell the shareholders about this. You can't do it in the audit report, so you tell them either in writing or at the AGM. The more complicated bit is if the directors reissue corrected financial statements. So they will correct the mistake that's been found and they do the accounts one more time. The auditor must check the correction, make sure they've done it right, check the directors changed nothing else, and then there's the third bit, and the third bit is the bit that needs to be remembered because it's the hardest bit you need to understand. You see, the problem is if the directors issue corrected financial statements, that means that the IAS 10 period now goes all the way up to there. And that means the auditors have got to audit it. So you get new active duty by the auditors before the signing of a new audit report. So that is the tricky bit to remember. Mistake found afterwards. If the directors reissue the accounts, you'll need a new audit report as well, and you'll have to audit up to today. There we are. That is subsequent events, a nice little self-contained audit standard with enough difficulty to it that it's one of the standards that sometimes comes up as a 5-mark part A of a question before a more practical question then follows on. So it's one standard where being able to explain the rules and also understanding them does normally get you a bit of a reward. Now that is the only little bit of technical I'm going to do at the moment, because tonight is all about doing the great big nasty risk questions. We've done one with the risk of material misstatement in it just now. To contrast with that, what we're then going to do, or now going to do even, is we're going to look at what I hope, if I've picked the right one, let's go and have a look. Yes, it is. From December 12, so a little bit more recent, is a question with some business risk in it. So December 12, get that date in your head. That is now today's date as we do this question. Down to the requirement. You'll see professional marks here are all 4 in one question because by 2012 that was the rule. But again, we've got a great big 28 marker and we've got no idea what it is. It just says, do whatever the partner says. So let's go and see what the partner said in this question. There it is. So, you are a manager in FOO, responsible for the audit of Grohl, a company which produces circuit boards sold to manufacturers, la la la. First time that you've managed the client audit manager taking over. So second time we're doing a question where we're taking over from the previous audit manager. Interesting. The year end is the 30th of November. Slightly interesting because this question came up December 12. So in fact, the year has just finished. So the audit planning is a little bit late, or later than it normally would be, I would have thought. And you've just received an email from Miavai, the audit engagement partner. Right, so 28 marks, what are we doing? Well, we can see it breaks into 3 bits, 12, 8, 8. I'm meeting with the other audit partners, discuss forthcoming audits, meeting with Mo Satriani. If you're a fan of rock music, I hope you're enjoying all these very famous names. The finance director of Grohl. Using the information from your meeting, I would like you to prepare briefing notes. Oh, what a surprise. Every sitting, don't forget, has been briefing notes. Oh, sorry, didn't mean to do that. Ignore that. Right, for my use, in which you evaluate the business risks. Right, business risks, we've got to focus on the potential damage to the company. Forget about debits and credits, yay! And talk about damage to the company, the potential risks to their business. Then we have got to identify and explain 4 risks of material misstatement. So then it's back to debits and credits and accounting standards. One slight difference here is we're only meant to mention 4, and that gets 8 marks, so 2 marks each. And that is more than normal and therefore an indication that we need to pick 4 that we can explain in quite a lot of detail. So if you find quite a lot of risks, note all of them, but try and pick 4 where you can really give some explanation. Part 3, discuss any ethical issues raised and relevant actions to be taken by our firm. Ethics again. So you see, ethics doesn't just come up as its own question, it's often in the big question 1 as well. Well, I know when I see the word ethics, I'm thinking of 4 things. I'm thinking SAFEM. I'm thinking conflicts of interest, integrity of client, and I'm thinking confidentiality. Where I see risks of material misstatement, I must make sure to mention which accounting standard rules and why I think they might get them wrong, and overstated, understated, etc. So in the first 15 minutes of the exam, that's what I would be scribbling on the exam paper. Not reading the story at all, just getting my technique down. Now, if this is the first question I do, and I think do them in order is the best tactic, I know not everybody does, but if this is the first question I do, fine, it will all be in my head still. But if this is the last question I then do in full, if I've planned my technique in the first 15 minutes and 2.5 hours later I'm then starting to write the answer, I'll have forgotten everything. So that's why you write the technique on the question paper in the first 15 minutes for all 5 questions. Decide which question you're not going to do and scrap it, and then start writing your answers knowing the technique will be staring you in the face throughout the exam. Trust me, it works. Okay, 12 marks. Normally it's 1.5 marks per risk. So the fact that it says 12 marks there probably is 8 risks times 1.5. We might be lucky, we might get away with 6. But because it doesn't tell me how many business risks, it might be a good idea to go 12 times a mark and aim for a dozen. So what we're going to do is read through the story and identify business risks. But also as we're going to be thinking accounting issues as well. So part A, we need business risks. Part B, risks of material misstatement. And I'm looking for 4 of those. And I'm going to aim for about 12 of those. And then in part C, let's just make sure we get this right. I think I remember what it said. But always a good idea to go back and just make sure. Ethical issues raised, relevant actions. And that's worth 8. Okay. I wonder, were there any business risks in that first paragraph? You're imagining food, audit of Grohl, circuit boards, manufacturers, electrical equipment such as computers and mobile phones. I'm thinking business risk, and in fact I'm thinking risk of material misstatement. Because I'm thinking that they are in a high-tech industry. And in a high-tech industry, you have to spend on new technology, research and development, and that can cause cash flow problems. Potential damage to company. Also, if you don't keep up, you will lose market share. So in fact, I think there could be 2 business risks in there. Risk of material misstatement. If your inventory is in a high-tech industry, there is surely the risk of obsolete inventory because it's high-tech, fast-moving, things go out of date very quickly, and that would lead to the risk of potential overstatement because of IAS 2 saying that it must be held at the lower of cost or net realizable value. Yay, we got some risks already. Good stuff. It then tells you that you've taken over from the audit manager, tells you nothing else about the company, so let's come down here. Principal business activity, production of circuit boards. One of the key materials is copper wiring, all of which is imported. Is it a business risk to rely on overseas suppliers? Yes, because if there's any transportation issues, your stock doesn't arrive. Is it a risk of material misstatement to be importing? Yes, because if you're importing, you suffer foreign exchange. That also creates another business risk, by the way. Risk of material misstatement, translation of exchange rates, IAS 21. Currency, absolutely. But you notice there how the same issue creates both business risk and risk of material misstatement. So, business risk in part A. Import could have transportation risks plus Forex exposure. If exchange rates change a lot, hard to manage the business, don't know what your costs are going to be, could suffer high exchange losses. Risk of material misstatement, I'd be talking about IAS 21, and there's two separate issues with that. There's the initial transactions need to be translated, and any year-end balances will need to be translated as well. In terms of payables, will need to be restated at the year-end exchange rate at the year-end. Well, this is looking good, isn't it? Yeah, lead time, transportation, all part of the business risk. I agree. As a cost-cutting measure, that sounds like a business risk to me. In April 12, hang on, what's the year end? Year end's November, so during the year, a contract with a new overseas supplier was signed, and all of the company's copper wiring is now supplied under this contract. One supplier. That's got to be a risk, hasn't it? A risk to the business. It's not a risk of material misstatement. I'd put it in here. One supplier. Means there's a risk that you are too dependent. What if that supplier goes out of business? What if that supplier goes on strike? What if that supplier's premises burn down? You've got no supply. Dangerous to put all your eggs in one basket. I can't see a risk of material misstatement from that one, by the way. Purchases are denominated in foreign currency. We've dealt with that already. The company does not use forward exchange contracts in relation to its imports of copper wiring. Therefore, they're not hedging against the risk I've already explained, thus making the risk greater. They're not doing anything to manage it. But I've sort of covered that one already. They have got two production facilities, one for the export market and one for the domestic market. Hey, export. They don't just buy from overseas, they sell to overseas, which means another risk of material misstatement, well, I suppose it's the same one, is the IAS 21 is not just purchases, it's clearly now revenue and purchases. So it works both sides of the business, stuff coming in and stuff going out. Now I notice part C there staring at me, not seeing any ethics issues and actions by our firm just yet, but maybe something will come up later. About half its goods are exported, but the export market is suffering. Now whenever you see those words, falling sales, you should be thinking IAS 36. Something is at risk of being impaired when sales are falling. And if they've got two production facilities, well, one of those production facilities is at risk of being overstated due to impairment. So in my answer, business risk is falling export sales, which is half their business, is suffering. That must surely create potential cash flow issues going forward. Risk of material misstatement, IAS 36, an overstated production facility if it's impaired, which it looks like it might be. The value of any asset is the revenue, the profits it generates. If those profits, revenues, whatever are falling, it suggests the underlying asset is potentially impaired. So we've already got 3 accounting standards showing you the importance of knowing your accounting rules. I suppose you could say cheaper overseas production is going to force down margins, another business risk. But let's keep going. Most domestic sales are made under contract with approximately 20 customers. Well, we said one supplier is a risk. Is 20 customers a risk? Suppose you could argue each one is roughly 5% of your revenue and 5% is material, isn't it? So I suppose we ought to put it in the answer. Business risk, only 20 customers. So similar issue to here, not as extreme. If you lose any of those customers, could have a big impact on your profitability. In early November, before the year end therefore, production was halted for a week at the production facility which supplies the domestic market. A number of customers have returned goods claiming faults. Well, that's going to be inventory. And if they're claiming faults, they'll want their money back, which presumably means provisions for refunds and IAS 37 as well. On inspection, it was found the copper used in the circuit boards was corroded, therefore unsuitable for use. Well, that's what happens when you go to cheaper suppliers. Corrosion is difficult to spot, cannot be identified by eye, relies on electrical testing. All customers contacted, products recalled and replaced. The corroded copper remaining in inventory has been identified and separated from the rest. So, business risks. Poor quality products is going to cause reputation issues and increased repair costs. Both are risks to the company, hence business risks. Risks of material misstatement, again IAS 2, overstated because it's damaged. I'm thinking IAS 37, understated provisions for repairs. You could even get clever here and say if that copper wiring is damaged and they bought it from someone else, maybe they've got a way of getting their money back, and then you start talking about contingent assets, also IAS 37. Well, I can already see, just from where we've got to so far, that the risks of material misstatement are not going to be a problem, are they? I've still got more to read. I only need 4. I can already see at least 5. Given I need to have 2 marks worth of comments on each of them, at the moment I'm thinking, where can I get 2 marks? My first one's very basic. It's an F8 level one. I'm thinking I can get 2 marks on that, probably 2 marks on impairment because it takes a bit of explaining, and because the foreign currency is both the initial transactions and the year-end balances, and it's their purchases and their sales, I think I can generate enough words to get 2 marks on that one. So those 3 at the moment are all looking like absolutely guaranteed to be going in my answer, but it does rather depend on what else we've got in here. Work has recently started on a new production line. Well, that sounds like an asset to me, IAS 16, which will ensure that Grohl meets new regulatory requirements, prohibiting is bad, the use of certain chemicals, which come into force in March next year. Well, new laws stopping you doing things sounds like a business risk. I have to go over here. New laws equals increased cost to the company and disruption to business. That's a business risk. Risks of material misstatement. Well, we've got IAS 16, costs of construction of the new asset are at risk of being overstated, understated, I don't know which. We'll keep on reading in a minute. Let's go back because I've already forgotten what it says. In July 2012, so during this year, a loan of 30 million with an interest rate of 4% was negotiated with the bank, the main purpose to fund the capital expenditure for the new production line. So, as my friend here has quite correctly said, the costs of construction should include IAS 23, the borrowing costs. And 30 million times 4% is 1.2 million. So the cost of construction ought to include that. £2.5 million of the loan represents an overdraft which was converted into long-term finance. So, not all the loan is to finance the construction. I've also just noticed the loan was taken out in July, August, September, October, November. So 5/12 of the year. So it's not a full year's interest. So coming back to the answer, it's not 1.2 million, it's 1.2 million times 5/12, which is 500,000, times 27.5 over 30, because not the entire loan relates to the construction. £27.5 over 30, I think, is 11/12. Crikey. I'll let you work that out. Not really that important for me to do it here, but whatever that comes out as, probably about 400 grand, should be in the cost of the asset. So I would suggest that the risk here is the risk of understated, because I think they might forget to include the borrowing costs, understated assets. But on top of all of that, it also says that there is a loan of 30 million. And I'm thinking various things about loans, such as the risk IFRS 7, not IAS 32. It's now IFRS 7, got to keep up to date with the rules. The risk here is under disclosure, because IFRS 7 is the one that says financial instruments, lots of disclosures. Loans are financial instruments. So there's a risk of under disclosure of the terms of the loan. Wow. Well, I'll tell you what, I'm liking the look of that one for 2 marks, because it's got calculations in it, and they're not that easy calculations. I can easily see 4 here. Might even put an extra 1 or 2 in my answer, just for safety. Business risks, mustn't forget those. They have just borrowed a big loan. And that risks cash flow, because you've got to pay the thing back again. Oh, sorry, let's go back to the question. Have we missed anything? Dealt with the new regulatory requirements, dealt with the loan. Other matters. Several of Grohl's executives and the financial controller left in October 2012 to set up a company specialising recycling old electronic equipment, not considered to be in competition, left on good terms. Replacements for the directors have been recruited. Well, as I may well have mentioned regarding Tesco's, losing lots of your main directors is surely a business risk, lack of continuity. Surely. It's not a risk of the accounts. New finance director. It is a risk of the accounts being wrong. That's a risk of material misstatement. New person, more likely to make mistakes. I'm not sure it would go into my answer though, because if I only need 4 in this question, I need 4 that are fairly meaty, and the new finance director is not that big a deal. I notice IAS 17 is being mentioned. I don't know if you're reading ahead and there's a lease coming up. I must admit, I haven't spotted any leases. So unless you've read ahead and there's a lease in the bit I've not read yet, no, can't see that. One of FOO's audit managers, Bob Halen, is being interviewed for the role of financial controller at Grohl. Finally an ethics issue. Not mentioned ethics at all down here, look. But if we've got a member of the audit staff going to the client, well, when we audit it, we're going to meet our ex-friend as the financial controller, aren't we? And that surely is a familiarity threat. If audit staff go to client, it might even create an intimidation threat, because people who used to work with him might feel pressured not to criticize anything he's doing at the company, maybe. Actions. With regard to this familiarity threat, well, you're going to have to try to create an audit team of staff who don't know Bob. But hang on, ethics, SAFEM, we've got one of those. Confidentiality, no. Integrity of client. Well, if they're interviewing one of our audit staff and we've only just found out about it, does that suggest they've been interviewing this guy behind our backs? Might be. And don't forget, the audit is being planned at the moment. If this guy's had any involvement in planning of this audit, or even in last year's audit, knowing he might be joining this company, which I suppose might happen, we might now wish to question the integrity of the client and of Bob. Why are we only just finding this out? And if you've got issues with the integrity of one of your staff, you should warn Bob to keep you informed about what's going on. You must take him off any work involved with this client. Why not? Well, we said familiarity threat if he goes and works there. The reason I don't want to use him on this client is another issue up here, which is a self-interest threat, because Bob has an incentive to keep his potential new employer happy. Or I suppose, intimidation threat again, the client might be saying to Bob, look, you make sure that nothing goes wrong on the audit and the job's yours. So it could be intimidation. At Grohl's most recent board meeting, the audit fee was discussed. Board members expressed concern, size of the audit fee given the company's loss for the year. Loss for the year could argue is a business risk, by the way. The board members would like to know whether the audit can be performed on a contingent fee basis. Fantastic, we've got another ethical issue. And I've run out of space. Yay. Always happens. So the contingent fee The issue is a self-interest threat because the auditor gains. Now, let's be careful here. Even I have to go and reread the question sometimes. It doesn't actually say what would it be contingent on. I presume based on something to do with the audit. I don't know. Not very clear, is it? The auditor gains if the company, let's assume it's tied to profit, shall we? If company profit goes up, so ignore anything that makes the profit go down. As I said, I am assuming there that by contingent they mean linking to profit. It could be linked to something else. Action. You have to politely decline. Contingent fees are banned for auditing. The fee must be based on the hours worked, not on some bizarre linking to something else. Now, I've not finished reading the story yet, but with 8 marks available for ethics, let's assume that there's 2 4-mark issues where you've got 2 marks each for the issues and 2 marks each for the actions. I think those 2 stories between them, the audit staff who might be joining the client and the contingent fee, are probably enough to get the 8 marks. To be honest, and now we have some numbers, and if you are given numbers, we ought to take a look at them. What do we notice? Oh look, revenue is coming down, operating profits coming down, finance costs of course aren't, and notice they've already got 800 grand of finance costs, which suggests they've already borrowed quite a lot of money in the past. That could therefore be a business risk, and look, they're making a loss. And do you know what else I'm now thinking? They've borrowed 30 million. Even last year when they were profitable, they were only making 200,000. Let's now put 1.2 million of interest charges in there. And you've got a loss of 1.5 million. Oh dear. So back we go to our answer. Although we've got no space left because we've spotted loads of stuff. That big loan is not just big, it is huge compared to the size of their activities. Huge. Business risks, falling revenues, and the company is loss-making. That is a risk. You can't keep that going forever. You've got to turn it back into profit at some point soon. Risk of material misstatement. I mean, you might even be tempted to now start to be saying that they've got going concern threats, given their cash flow situation. You could even be talking here about IAS 1 under disclosure of their cash flow problems. Could perhaps be another issue. But as I said, you only need 4, and there are way more than 4 here. These questions, you've got to move through them fairly quickly because there's so much information. And please note, I could write a full marks answer already. I could actually stop reading now if I wanted. It then tells you what their assets are, 180, cash at bank, and then tells you, as if you needed any more information, if their current ratio is 1.1 and their quick ratio is 0.8, surely another business risk, which we can't fit in here, is liquidity problems, because the current ratio and quick ratio are close to 1, meaning they can only just about afford to pay their debts, it would seem. So for parts A, B and C of this question, or 1, 2 and 3, whatever they were. There are loads of business risks, loads of risks of material misstatement. Okay, there's only 2 ethical issues, but they're not very difficult. And to be honest, that is how it tends to be. Business risks, if it comes up, there'll be thousands of them. So just get in and start writing your answer fairly quickly, but remembering to explain the potential damage to the company. Don't just say reputation damage. Say reputation damage caused by the poor quality of their products, meaning they're likely to lose customers, and remember, they've only got 20 of those. Lose customers, bad publicity, difficult to replace the customers with new ones, all at a time when their cash flow is a disaster, the export market's not good, in a high-tech industry where they've got to keep up, they've just borrowed a stack of money, hence you can talk cash flow issues. Again, this is a briefing notes question. So in your answer, some of the professional marks will be for maybe trying to segregate the business risks. Because let's face it, you could talk about inventory issues, you could talk about reputation issues, you could talk about the several clues that they've got cash flow issues. You could talk about overseas issues like foreign exchange, transportation, poor quality. So try and group the issues if you can under headings. And that's the only real reason for planning it in advance. I'm tempted to say under exam time pressure, with big stories, you might have to give up on the grouping and just as you're reading it through, be writing the answer as you go. Anyway, I think that pretty much proves my point. But there is one final bit of the question left. Because after all of that 32 marks of fun, she puts a little 8 marker in at the end. And do you know what? A lot of people never get to the 8 mark bit. They spend way too long on the big 32 marks and they never get to this bit. Now that is one of the reasons I strongly advise you to plan your technique before you start answering any of the questions. So in the first 15 minutes, I would have looked at the last part of this question and I'd have seen what? I would have seen comment on the matters that should be considered. Okay, so that's what is the relevant accounting rules? Has the client got it right? Materiality. And recommend the audit procedures. Audit procedures, look. AEIOU, DADA 3, test the story. And given the story is relatively small, and I know my technique for this very well, because this stuff comes up frequently, I might be tempted to just go read the story now and see how many of those 8 marks I can get. Now, I can see it says insurance claim. Well, insurance claims are the classic example of IAS 37 contingent assets. Because if they're claiming for something, and if we believe they are probably going to get this insurance claim paid, then they should disclose that, no debits, credits, disclose it as a contingent asset. So, matters, IAS 37, if claim likely to succeed, disclose as contingent asset. But that's the only thing I can say about it, really, in terms of matters. I can, however, already state one piece of evidence. In fact, 2 pieces of evidence. Because if it says, in respect of the insurance claim, one thing I surely will want to do is take a look at the insurance claim to prove they have claimed. And also I'd like as evidence a copy of the insurance policy to help me assess if claim is likely to succeed. And because this IAS number 37 is all subjective and about opinion, I would also want a written management representation confirming management's view on the likelihood of success. And you know what? I've got 3 bits of evidence and 1 accounting matter, and that makes 4, and 4 out of 8 is a pass. And I've not even read the story. I just look at insurance claim and I know what sort of stuff I can think about, because I'm thinking through my AEIOU, my DADA 3 for ideas. I've got documents, I've got directors. I mean, I might even get a 4th bit of evidence, third party. Could we contact the insurance company and see if they're able to tell us of the likelihood of success? Or maybe get legal advice on the likelihood of success. But let's now go read the story and finish this one off. You've just received a phone call from Mo Satriani, the finance director, in which he made the following comments. There is something I forgot to mention in our meeting. Our business insurance covers us for specific occasions when business is interrupted. I put in a claim on the 28th of November for $5 million. So when I look at the copy of the claim down here, to prove they've claimed and to verify the date was before the year end and it's for $5 million. Which I have estimated to cover the period when our production was halted due to the problem with the corroded copper. This is not yet recognised in the financial statements, but I want to make an adjustment to recognise the $5 million as a receivable. Right, so matter to consider, it is not a receivable unless it is almost certain to succeed. Not highly likely, but almost certain. I can also do materiality, because $5 million, well, that is almost half their revenue for the year. It's 25 times last year's profit. What's their assets? 180 million. 5 divided by 180 is almost 3% of assets. So that claim is 3% assets, about 40% revenue. So it's clearly material. And then the rest of my answer is trying to assess the likelihood that it's going to be one, it's going to succeed. Now hang on a minute. This guy is saying that the corroded copper has caused problems in the business. Well, yeah, obviously it has. And that this has caused $5 million of damage. Really? But if that's about 40% of their revenue, what's he saying? That they shut the facility for 40% of the year? Are they saying repair costs are $5 million? So what, if this hadn't happened, you'd have made $5 million profit? Well, based on last year's 200,000, I don't think you would have made $5 million profit, would you? That number looks very excessive. Hugely excessive. And to be frank, I'm not even convinced if you burn by cheap materials and then they don't work, well, that's your fault, isn't it? Does insurance even cover that? Insurance is normally for things like fires and floods. So in my answer, I would have to highlight the fact Well, it would help if I was looking at the right page. In terms of matters that it's unlikely to succeed. Sorry, let's not do that. I've no room there. Let's bring it down here. It probably won't succeed because it looks too much. I mean, how long did they shut down for? Didn't the story tell us? Let's just go and have a look. Where was it? Oh, here we go. Production was halted for a week. And also the reason for the disruption is the client's fault. They took a risk, they bought cheap materials, and it's come back to hit them. I can't imagine this would be paid. Now, it is the case that on this exam, in the big question 1, there is often a fairly small bit after the big bit, and the small bit is often fairly easy, and that's fairly easy. It's a fairly small story, it doesn't take long to read, and it's relatively straightforward and on an exam question type that you should be well practiced for by exam day. So what does this tell us? Well, what it tells me is in the first 15 minutes you plan your technique for each part of every question. And if you see a question like that as number 1, when I start doing my answer to that question, I'd answer part B first and then go and read part A. Now obviously if you haven't read part A, you don't know production only shut for a week, but you could certainly plan your answer for part B, realise it's not difficult, plan the answer for part A, but then write the answer for the small bit first. Because you are likely to have time pressure because it's such a big story. And if you run out of time, you might forget to ever start answering B. And it's not hard, is it? Well, we've reached 8:45. We've done 2 huge questions. So in our 2 3/4 hours tonight, we've done, what, over 70 marks worth of question? And we've done it with me explaining it as we go. So that is really good quality evening. And what's nice about the evening we've done tonight is we've been doing risk, but we've also managed to get in and look at some practice management. We've got some ethics. We've done some matters and evidence as well, all of which helps us to reduce the number of matters and evidence questions we have to do separately, because they're in these questions as well, you see. So it helps us later in our revision. Now, the third question planned for tonight, what I do with that is I ask you to look at it so that when we do evening 3 next week, I can go through the next one. The next one's got groups in it. So this is this one here, June 12, question number 1. So can I ask you, take a look before our next class, so I can use that question to help look at more risk and also revise a bit of groups as well. Apart from that though, our time, it is up. So well done for sticking with it. Thank you for the comments. That is it for revision class number 2. We are well on our way now, getting through all the good core topic stuff, which is the whole point of the course. And I will be seeing you next week for class number 3. And consider this as you enjoy your weekends. Tomorrow morning I start a P7 revision course. I'm doing it all weekend and I get to do all these lovely questions again. Yay! All right, enjoy your weekends, guys. I will see you next week for class 3. Good night. And happy Halloween! Whoa!